Hello and welcome. You're watching All About Your Company here on ET Now. I'm Harsh Saita. Today we're going to be talking about MM Forgings. As the name suggests, it's an auto component manufacturer, and therefore we've shifted focus this week at least. We've started to get a sense that maybe the CV cycle is on an uptick domestically, and therefore some of these names could well be interesting to have a conversation with, to try and understand what the underlying trends are, and therefore MM Forgings becomes important. You can see the last 7-day chart on MM Forgings as well. But let's quickly first talk about company-specific data. Q2 was a very soft quarter for MM Forgings, frankly. It was a tough quarter, and two reasons why. One, the top line didn't support in terms of growth, and as a result, you saw also a margin shrink. They've generally aspired to keep margins in around the 20% level, but margins shrank to sub 17%, which is where challenges started to happen. They've obviously spoken about a rebound in H2 and a very strong rebound in FY27. And we'll probably talk a little bit about the US market first off, to try and understand what the export rebound looks like and what the new tariff regimes mean for an MM Forgings today. And mind you, viewers, the share of US exports by MM Forgings was 16% last year. Now it's fallen to 9% in H1 FY26. So you've seen a very sharp shrink as a result of the US tariffs, which is clearly impacting MM Forgings this financial year. So we'll assess that. We'll assess the impact of that on margins as well. How much of the tariffs is being absorbed by MM Forgings, because they do have the bandwidth to absorb it, and how much of it is actually passed through. So that likely will be more tactical to try and retain their current customers sitting in the US. Now, so that's point number 2. We'll try and understand the US dynamic. Point number 3 is uptick in FY26 with regard to domestic sales. And domestic, where the growth is visible, they've guided for 750 to 800 crore of top line. If they do this, it will be a flat top line FY25 versus FY26. They've guided for a potential 500 crore uptick in the top line from 1500 crore to 2000 crore in FY27. So we'll try and understand how that plays out as well. Also, we'll try and understand if there is this uptick in FY26, where do margins land up? Because margins have shrunk, as I did explain. If they do this top line, do margins also have an upside potential, is what we'll try to understand. The fifth piece is, why are they so bullish with regard to FY27? Will it be a breakout year? They are talking about it as a breakout year. What keeps them that bullish with regard to FY27? We'll try and get some color on that. And what are the other opportunities outside of the current business with regard to CV, PV, which is a very small part of the business, and off-highway, which is also a very small part of the business? How large are the other opportunities and how are they shaping up? We'll try and understand all of that. Now, let's talk about the company first off. The company itself is a precision open die steel forging manufacturer. I'll explain some parts of that. Its focus is on automotive and engineering sectors. 80% of the components are for commercial vehicles, 10% for passenger vehicles, and 10% for off-highway. So that's broadly the split. Let's also take you through the export mix. It's around 38-39% of sales is exports, and the target capacity as of today is around 1.45 lakh tons. That's what the utilization target is. They're currently doing around 1.26 lakh tons in terms of total capacity, but the aspiration is to get to 80 to 90,000 tons of sales this year. So that's the broad brush understanding. In terms of the key products, they sell to CV and PV. They sell forgings. What are forgings? They are steel components which are heated and hammered into shapes and sizes in terms of not just steel but also other metals, and are used in auto components and auto manufacturing by OEMs. So various use cases, CV and PV, of course, agri, off-highway, the other one. Machined components, those are like shafts. Shafts are, they are auto components like screws, and you require them across the auto industry and across manufacturing in auto. And therefore, that's broadly what shafts are. And therefore, you can just liken them to the auto cycle itself. And if the auto cycle were to pick up, then demand for this would obviously pick up as well. Let's talk about the geographic mix. 61% is India, 21% is Europe, 9% is US. This has dropped from 16% last year, mind you, viewers. South America is about 6 and others is around 3. So that's the broad brush split. Europe obviously is another very critical market. Also, the customer concentration is sharp with regard to MM Forgings. That's the other thing you want to keep in mind. Believe the top 10 customers will contribute over 50% of the revenue. That's the current capacity, which you can see on your screen. What you can also see is the split between CV, passenger cars, off-highway and engineering. And broadly, that split is 80:10:10, which is CV is 80, and then passenger cars and off-highway is 10:10. The last piece is with regard to customers. Hyundai, Ashok Leyland, Wheels India, Renault, Axles, Tata Motors, PV, just some of the many customers that they cater to. Renault, of course, within the European market, as well as has presence in India as well. Let's talk about some of the metrics now. And the financial metrics gives you a lens into what they've done over the last 3 years. You look at FY22 to FY23, there's been a pickup. But after that, we've seen flattish kind of numbers. We remain cautious here. We've given it a neutral. The growth hasn't come through, but it's a 10% revenue CAGR over 3 years, largely back-ended, which is in FY21, FY22, FY23 is where the growth has really come from. Maybe not FY21, but 23 is where the growth has really come from. So more back-ended. In terms of the EBITDA itself, it's grown at 13% as well. They've optimized, despite revenue growth not coming through, they've been able to optimize in FY24. FY25 has been a relatively more difficult year. And the goal is to keep margins range bound, right? 20% odd. In terms of the net profit, that's how it's shaped up, around a 14% odd CAGR, but again on a very low base of FY22. Let's look at how H1 has shaped up now. And this will give you a sense of what I'm speaking about. You look at the negative 4% revenue growth, but you look at the negative 15% on EBITDA, which means margins have shrunk. And net profit, so margins at 17.3% versus 19.7% last year. And net profit at 40 crore, which is down 41% on a YOY basis. Let's look at margin trajectory as well. They've largely been able to maintain margins, frankly. It's just the recent quarter or half year where we've seen that dip come through. 16.7% in Q2. FY26 is what they've done in margins. Power costs going up, employee costs going up, sales not picking up, a lot of that contributing. So top line as well as your expense line going up, top line coming down. That's where all of the pain has come from. Now let's talk about the balance sheet. And in terms of the book value, it's at around 1,000 crore versus the market cap of the company of around 2,000 crore. So it's trading at around 2 times book at this point. You look at the borrowing number. That's where some part of the concern could emanate. So you've got around 1,200 crore odd of borrowing currently at the end of H1 FY26. And they've got cash bank balances around 230 odd crore as well to offset. Management has guided that the peak of the net debt number will happen at 850 crore, which is also large, frankly, because you've got a 900 crore base or 1,000 crore base in terms of equity. 850 crore of net debt is large for a company like that, but they have the cash flow to support it, which is that they've got 200 crore of cash, but this is net debt. So that's the other thing that you want to keep on your mind. So balance sheet, we've been cautious about it. Let's look at cash flow. Here too, we're a bit cautious, and that's because the conversion hasn't happened. A lot of the EBITDA is sitting in working capital, receivables as well as inventory. That's something that needs to unwind, and eventually it will. 50 crore of unwind on the inventory is already been guided for in November, on the November con call that they had. So some amount of inventory unwind will likely play out. Let's look at now return ratios, but we'll wait and watch for this conversion or this unwind to happen. You look at the return ratios, not enthusing. They're at in about the 15% mark at the very top. When it comes off, well, it's looking more and more difficult. And currently it's at 12%, of course. And therefore, again, we've been cautious here. We've given this a neutral rating. And clearly not a thumbs up because we're not seeing that 15% plus kind of ROC sustain. And or even hold for that matter. They've been able to hold 15 and then they give it up. So that's the trajectory over the last 5 years. Let's talk about shareholding. This is where you're seeing promoter holding at 56% consistently across all the years. FIs, DIs have very minor participation. Balance is held by the public, and public shareholding has gone up substantially in terms of number of shareholders. So the number of shareholders were roughly 15,000 in FY23. It's risen to 36,000 now. So that's something that you want to keep on your radar because it means that participation has gone up within this counter. But outside of that, the promoter ownership gives us the confidence to give this a clear thumbs up. Let's talk about valuations. And I've taken trailing 12 months valuations because there's no coverage on an MM Forgings. It trades at 16 times versus Balu at 28 times and Ramakrishna at nearly 30 times. We've given this one a neutral as well because you have to contextualize this with the risks that you are looking at for an MM Forgings, which is higher debt, exposure to the US and the tariff situation, and in comparison, the impact of that on the numbers of MM Forging versus the others. The absorption, maybe the others are better placed at that, and therefore we've given this a neutral. We'll wait and watch. But if the execution were to play out the way the management is saying, 500 to 700 crore of top line added in FY27, this could well be a big game changer for the company. Let me bring on board to speak about exactly this Mr. Vidyashankar Krishnan, who's the Chairman Managing Director at MM Forgings, who's joining us this afternoon to talk to us about how one should look at the business and what the outlook looks like. Mr. Krishnan, it's first off great having you. Let me start off by understanding what's gone wrong in... Right. Sir, let me try and understand what's gone wrong in Q2 and how much of that is attributable to US tariffs. First, let's start with that. Your power costs went up, your employee costs rose. Do you get operating efficiency once you scale up on some of these, at least on the employee costs? Or is this rise disproportionate and because of top line or lack of top line growth, your margins compressed? Give us a sense of what's happening.
Yeah. See, what has happened in the last 7-10 months is that sales to the US has dropped substantially. Not because of tariffs, but because of inventory at customer end. Basically, they had bought earlier and their anticipated sales did not take place, consumption did not take place. So ultimately, customer ended up with a lot of inventory since April. And they have therefore reduced their offtake substantially from in H1 and in up to Q3 itself. So that has resulted in US sales coming down from about 17% to around 9% of overall sales. Means we've lost almost 10% of the market in America alone. It's not a loss of market precisely. It is more of a downturn in the market. And customers are now starting their buys from December end onwards, and that's shaping well into Q4. And from Q1 of next year, this will be pretty strong.
Yeah, so
that's one of the major reasons why we have seen sluggishness in this year. Apart from this,
I read your... Right, sorry. Please go ahead.
Apart from this, we also have to consider that we have invested considerably, about 1,000 crores in the company in the last 5-6 years. And that has not resulted in commensurate top line growth, for the reason being that many projects with customers have been delayed at customer end, and a few projects execution has been the issue at MM Forgings. So combination of both together, we have not seen this year, FY26, for example, we should have seen a shift in the needle from the 1,500 crore level to about 1,000, at least 1,700, 1,800 crores. So that has not happened for the reasons of shifting of customer projects, customer end, and due to internal reasons. Largely, those have all been debottlenecked, and customers are back with their projects. So this coming year, FY27, we have clearly targeted a 15 to 20% growth. I saw your presentation a few minutes back. I mean, that was really a good appraisal of MM Forgings. However, I don't know where you got the figure of 750 crore of projected growth from. That seems to be rather on the higher side. I don't remember us talking about such numbers, but FY27, we are very sure that we are looking at 15 to 20% growth.
Okay, point taken and correction. But FY26, as part of a guidance for at the end of Q2, you suggested that there has been an uptick in the month of November, and from that point you were expecting an uptick in terms of growth. How strong is that uptick? Because now from what I'm gathering from you, you still seem only cautiously optimistic. You seem to be suggesting that December end is when the uptick has happened, and that Q4 is when the numbers will start reflecting.
Q3 will be largely muted. Q4 will start the uptick, and that should go on quarter into FY27. October was a dull month due to Diwali and customer and shutdowns. So November and December onwards, we see a strong customer buy.
Right. And is the growth going to come from US? Is that where you are seeing the traction? Is that what you are referring to in terms of the growth traction that you're seeing?
Growth is coming across the board. It is broad-based, largely coming from US and India as well.
Tariffs are not a concern where US growth is concerned?
Sorry?
Tariffs are not a concern where US growth is concerned?
I would say this entire scenario of 15 to 20% growth is based on a couple of assumptions that things remain where they are at this point of time, geopolitical and macroeconomic, and there is no further deterioration, because we can't keep on pouring water into a bucket that is continuously leaking. So assuming that these conditions prevail, we would expect certainly that the company would grow its top line.
Okay. What if the US tariff does not get resolved? What happens then? Are you absorbing the tariffs yourselves to a certain extent? What are you doing, and how are your customers responding to this? How are you responding to this? How much of the tariff are you absorbing? How much are customers absorbing? Because retaining the customer would also be strategically important, right? This is not a 1 year or 2 year business.
A very good question and a very difficult one to answer. From our customers, we've heard that as of now, they are absorbing the tariff increase. So, and they are also looking at it long term, because these level of tariff increases, I don't think any manufacturer can bear. So, as of now, customers are looking at absorbing the tariff increase, and they are grinning it through. Hopefully, resolution should be seen. Now, what happens long term?
They are fully absorbing it, sir.
Sorry?
They are fully absorbing it. They are fully absorbing the tariff at this point.
No, yes. As of now, they're fully absorbing.
Okay.
And they would intend to do so over the next few months. But beyond a year or two, how this would pan out would be a huge question mark for all across the globe. And it's very unlikely that, we can very unclear on what will happen if such tariff levels continue or even escalate.
Are your customers passing those tariffs through to their customers?
Mostly they are. Okay.
I'm trying to understand how the dynamic is working. Okay, but this is insightful.
Mostly they are, but okay. Some of them are absorbing, some of them are passing on. It all depends on what strategy they follow with their respective customer. But ultimately, this is going to be inflationary on the American consumer.
That's what I'm trying
is
to judge.
without doubt. Whomsoever bears it over a period of time, this is not going to come from an exporter's pocket. It is going to come from the importing, consuming community, which is the American public. And that, I think, has to be seen by the powers that be across the globe.
Perfect. You've guided for 750 to 800 crore of top line in H2 FY26. How likely are you to get there? And talk to us about the domestic CV cycle. You have, 60% plus of your top line comes from domestic. And are you seeing a sharp uptick there? Are you seeing a gradual uptick? Are you expecting that uptick to last 1 year, 2 years? Give us some color on that and the H2 top line.
Okay. H2 will be on the lines that we had said earlier, will very similar to H1, and we should see the numbers that you spoke of, around 750 this way, that way. We are on target for that. With regard to the CV market in India, Q4 appears to be, that is the coming quarter, January to March, appears to be very bullish. Customers are increasing their offtake considerably across the board, and wherever we have built up inventories, those inventories are fast dwindling.
Okay.
So we
And
see
with
strong
regard,
demand
sure.
from customers in Q4.
Okay. And where does that leave you where margins is concerned? Say you surprise on the upside by doing 800 crore of top line, right? Where does that leave you where margins is concerned? Will the full year margin recover, or would the Q2 margin number dent the full year margin number to some extent?
Naturally, H1 numbers will have an impact on the overall numbers because that is half a year, and the real growth comes in from Q4 onward. So 3/4 of a year have been muted. Naturally, that will have an impact on margins. I would expect margin bias going forward to be positive.
Okay.
I know that's a guarded answer, but that's all I'm permitted to say as well.
No, I fully understand. Thank you for that. You're going to up your capacity from 126,000 currently to 145,000 tons. Where does your capacity utilization lie? You've guided for FY26 capacity utilization at around 80 to 90,000 of the 126 that you currently have. At 145, what do you expect your capacity utilization to be? US will ramp up, India is ramping up. You've got a very good mix going your way. So why not be more bullish in FY27 is what I'm trying to get to.
Oh yes, we are. We are looking at 15 to 20% growth in FY20, not in FY26, FY27. See, FY26, we were bullish a year back. But what has happened is that customer projects have gotten shifted out in so far as time. But we have not lost any. That's a good point. The most important thing is that we have not lost any customer order. All the relationships are intact, and there's been a shift from the customer side. Some launches have also gotten delayed. Some technical,
Right.
some commercial, but largely the relationship and the underlying orders are all intact. So having said that,
FY27, right.
yeah, that is why FY26 has been a dull year. On top of this, we have to superimpose almost a 100 crore drop in sales to America, which is significant, right?
Okay.
So all these things
Yes,
together have
it
pulled
is.
down FY26 numbers.
I understand.
Now going forward, we have clearly mapped out that FY27 will be to some extent, as what you called very rightly, a breakout year.
Will you do 20% margin in FY27? Will you do 20% margin?
Margins,
Right.
I would be a bit muted. Margins are positive.
Okay.
That much I can say. Subject to macroeconomic conditions, margin bias is definitely positive. There is no reason why we should match earlier numbers. No reason at all. But the needle should move surely in FY27.
Okay. And with regard to your debt, when you get to 850 crore net debt, and when does it start coming off? Just give us the timeline glide path for that.
Okay. FY26 and 27 will be years of peak debt. We are going to keep debt at these levels itself. So we are not going to add to the debt under any circumstance. we have about 1175 crores of total debt, offset by about 215 crores of cash. So we're looking at about 800, 900 crores of peak of debt. And that is kind of like peak, 900, 950 crores of peak debt. We are not going to move beyond that. In FY27, debt will remain at these numbers as of now. But as we improve our sales and improve our margins, definitely debt levels will come off from FY26 levels.
Okay, excellent.
That's the plan.
Mr. Krishnan, it's been a pleasure speaking. You've been very detailed and very candid. Thank you for that. Means a lot to the viewers and to us. And viewers, that's all the time we have on this edition of the show. Thanks so much for tuning in.